So tell us, how does this, some kind of a regional a branch of the Federal Reserve Bank, become such an important talking shop?
Well, the Kansas City Fed has established a really nice tradition of having a meeting in late August, which is a pretty dead time, in an amazingly beautiful place. And so they get top bankers from around the world. It's really more of an academic conference. So I think it was a little bit misleading for people to expect that Janet Yellen would really indicate new policy. She's already started speaking, and I think she's indicated that they're moving, she sees the U.S. economy moving toward what they call their dual mandate of healthy economic growth and employment on the one hand, and inflation moving to about 2% on the other. So she sees a case, strengthening case for higher interest rates, but she's not really tipping her hand. The market still thinks the odds of a move in September are quite low, maybe 1 in 3. Personally, I don't really expect the move to come until December, but she continues to emphasize that it's all data dependent, meaning that we need to get good economic results in the next few months for there to be any hike at all.
Let's talk about hikes later in this program, but I want to toss our next question to our London guest, Mr. John Ross there. So someone are calling this a Davos of central bankers. Is that an exaggeration?
Well, I think it is an exaggeration, except in the sense that Davos normally doesn't have the strongest possible Chinese representation because it's held too close to the Chinese New Year. And of course, you don't have the second most important banker in the central banker in the world, that is China there. So therefore, it's not really a power-making thing. What it is a major meeting of Western bankers. She has a very difficult situation because if you consider the growth figures in the US, they're pretty bad. I mean, the US GDP figures came out, second revision came out earlier today, 1.1% growth in the second quarter. That's annualized quarter. If you take year-on-year growth, I haven't had time yet to do the calculation on the revised figures, but on the earlier figures it was 1.2%, and that slowed from 3.3%. So the US economy is not growing very fast. On the other hand, it is creating a lot of jobs. That's because productivity has now fallen for 3 quarters. So she's got some inflationary pressures potentially within the system. So she's got rather a difficult decision, in my opinion.
Mr. Chu Sitao, I saw you shake your head. Is it a difficult decision for Yellen?
Yes, well, in a sense, because she has been led by market forces. Right. So in the long run, if the most important central bank continues to do that, you risk the risk of losing certain credibility. But I very much agree with what Dr. Dollar has said earlier. I think for the rest of the year, she's likely to do that once. But the trend is going to be very, very slow, very gradual, next few years.
So what would happen after this if she really announced that decision to raise the interest rate in December, like you said?
Well, if she does that, I think that's already being discounted by financial market. Then the question is how rapid the future rate hike will be. But I really think what the Fed is being confronted is very different from past, because these days you have to look at China. So some of the previous decisions actually being affected by conditions in China. That's something the Federal Reserve never have to deal with in past years.
Dr. Dollar, last year in December 2015, we saw a landmark interest rate hike by the Federal Reserve Bank, and then we're also seeing a stock market losing ground at the beginning of the first week of the year 2016. So what does that mean for this time if a possible interest rate hike would happen in December this year?
Well, when they made the first move in December of 2015, they thought the world economy was strengthening, but in fact, we then got very disappointing results for the US. China created some uncertainty with further depreciation of its currency in December 2015. So I think one move is not going to be a big deal, but the fact that they haven't moved since indicates that they were wrong to think that they were going to be on a steady path of global growth accelerating. There's a risk of this happening again. I agree that the market's pretty much priced in a move in December. Again, 125 basis point move is not going to make a big difference. They're projecting that the world economy is going to be accelerating. I really hope they're right, but they could be disappointed again, and we may find very few further interest rate hikes during 2017.
It's really interesting that we are all watching so closely at this possible interest rate hike. My next question goes to you, Mr. Ross. So some are worrying that the Feds are increasing this interest rate as to increase the market worries, and the others are saying that it'll also create bubbles in the stock market if they doesn't. So it's really a big deal for them to do or do not.
Well, when I said that they're facing a big decision, I mean, really I'm thinking about the question whether to raise them in September. I've got little doubt that she'll raise them during either September or December, because she sort of boxed herself into a situation in which she doesn't. The Fed will lose a lot of credibility. But don't forget, at the beginning of the year, the projection was for 3 or 4 rate rises. So therefore, the rate rises are coming much more slowly than was expected. On the question of asset bubbles, you have unprecedentedly low interest rates. I don't merely mean the Fed ones, but in Europe, you've got the lowest market interest rate for several centuries. Under those conditions, you're bound to have had the formation of asset bubbles, and there will be quite a significant market correction at some point when it's put up. It's another reason why, incidentally, the Fed will delay a long time before putting up interest rates. The fundamental reason, though, however, that the interest rates are so low is because the world economy is growing extremely slowly. In particular, if you take the US, the big news during the last year was not China, which slowed marginally from 7% in the first quarter of 2015 to 6.7% in the second quarter of 2016. The real big slowdown was inside the US, which was from 3.3% in the first quarter of 2015 to 1.2% in the second quarter of 2016. I think that's abnormally low. The US average growth rate the last 20 years is 2.3%. So I wouldn't be surprised to see some acceleration from this very low level during the rest of the year for the US, but nevertheless its fundamental growth rate remains very low, and the US is still the world's largest economy. It means one of the main modes of the world economy is not going very fast.
Well, Mr. Sitao here in our studio. So from 3.1% in the US to 1.1% of GDP growth in the US. After all, US is a really big economy. 1.1% is not that bad in terms of numbers. So we're also looking at possibly 3% of interest rate in the U.S. by the year 2018 or 2020. That means the bigger trend is still going up.
Yeah.
Are we that optimistic?
The bigger trend is still up. I think by large, U.S. economy is doing well. Labor market is strong. Housing market is strong. Of course, you have pocket weakness here. They're being affected by energy, by agriculture. But overall, I think U.S. economy is stronger than other major economies. But I think the challenge confronted by the Fed is you are going to have a few major central banks having negative interest rate. That's why one of the academic debate in this conference is how do we deal with nominal negative interest rate. I think another uncertainty potentially is China should cut interest rate. China should cut reserve requirement rate. If Fed is not raising interest rate, China would have done that already. So I think that's really the major challenge confronted by the Fed. You have this divergence between short-term interest rate between U.S. and many big economies.
Speaking of short-term versus long-term, in fact, Yellen's speech is titled Federal Reserve's Monetary Policy Toolkit. So what's in her box? Any ammunitions that she can use?
I think she already defended some of the tools, so-called unconventional monetary policies, asset purchase, so on and so forth. I think she already suggested should economic downturn return, I mean, those tools will be put in use.
So, of course, we're looking at any indications of how the Reserve Bank and other global central bankers would fight the next possible economic crisis. So, Mr. Dollar, what's your take on this toolkit?
Well, I think in her speech, she's emphasized that there are important factors in the world that are behind this slower growth. She cited the demographic factors, slowing of population growth, slower productivity growth. And so she's saying that probably peak interest rates are going to be much lower than they were in the past. You know, we may only get a couple of Fed rate hikes before we have the next recession. And so she's looking, she was defending the toolkit that the Fed used in the global crisis. And she's saying you have to expect central banks to be using these tools in the future. Equilibrium interest rates are going to be lower than they were before, and therefore lowering interest rates is going to have less of an impact than it had in the past, and therefore you have to be ready for asset purchases and other types of extraordinary policies. So it's really kind of an academic speech where she's emphasizing what kind of tools they're going to have in the future the next time the U.S. and the world faces a recession.
But the question is, Mr. John Ross, will these tools be effective if a major financial crisis is facing us?
Well, there's two different things. One is I don't actually think a major financial crisis is confronting us. What I think is the situation is what Madame Lagarde, Managing Director of the IMF, correctly called the new mediocre. But the tools of the US economy have been extremely ineffective. The economy has been slowing for the last 50 years. Its average growth rate has declined from 4.4% to 2.3%. And purely factually, during the last 18 months of the three big economic centers in the world, the US experienced the biggest slowdown. European GDP growth was 1.8% at the first quarter of 2015, and it's 1.8% in the second quarter of 2016. China went, so it didn't fall at all. China went from 7.0% to 6.7%, but the US went from 3.3 to 1.2%. So it's a pure myth that the US economy has been doing well. It has very high population growth, 0.8% a year. If you take US per capita GDP growth, it's 0.5% over the last year, which is frankly very anemic. And the jobs increase is not really an indication. The reason that the US economy is creating a lot of jobs is because its productivity has been falling for 3 successive quarters. So therefore, the jobs indicator is not a good indicator of the strength of the economy at all. So therefore, I don't expect to see it continue to fall. As I say, it's very abnormally low at present time. But all the evidence is that the tools are extremely ineffective in stimulating the US economy.
Dr. Dollar, I would like to hear your response to Mr. John Ross' description of ineffective tools.
Well, I was speaking before. I think the monetary policy tools have done what they can, and I think we've reached a point where there's a limit to what you can do with only monetary policy. And in fact, Fed officials like Janet Yellen have been emphasizing this. The U.S. needs to do more with fiscal policy. We're not investing enough in infrastructure. With interest rates low and unemployed labor, we should be expanding our infrastructure spending. You know, we could do that with deficit financing initially, and then I think we need higher taxes eventually to pay for that. We need new trade agreements like the Trans-Pacific Partnership. So I think there's a structural and fiscal agenda for the United States that we're not acting on sufficiently. And given that, there's a limit to what monetary policy can do. And I don't have any complaint about what the Fed has been doing, but it's not being supported by Congress with other measures. It's not being supported with structural reform.
Just like you said, there's so much that monetary policy can do. But the topic of this year's symposium is called Designing Resilient Monetary Policy Frameworks for the Future. Mr. Xu Sitao, how do you explain this resilient monetary policy?
I don't know how to explain resilient. I do have Well, I do agree with David Dollar's view. I mean, you are seeing a diminishing rate of return of monetary policies, but at the same time, if we don't use such monetary policies, the situation could be much worse. So I think I got no answer to the so-called resiliency.
Dr. Dollar, what's your interpretation of this resilient? Because I don't understand. So help me.
Well, I think, as I said, I think the Fed officials have been clear that while they're careful to criticize U.S. fiscal policy and structural issues, I think they've been pretty clear that the U.S. is not doing enough. And then they have to think about, given that, what is the sensible monetary policy framework? And so I think, frankly, they've been doing a good job. I don't buy into this argument that that they need to get way out ahead of the market expectations on raising interest rates. They need to. They're doing what they can do in this environment, and they're thinking about how they can deal with a recession if it comes when their benchmark interest rates are still relatively low.
Let's take a look at a bigger picture. The aftermath of Brexit is still lingering, and we're also seeing volatility there. I would say that we're having one heck of a few post-Brexit tough months. So how would this put into the bigger picture of the global economy, Mr. Xu?
I think after the Brexit, first of all, stock market covered very quickly and nicely, and we've been seeing repeated new high of major stock market, U.S. particularly. So I think asset market has been quite sanguine, but at the same time, we also see reinforced strength of the U.S. dollar, which means strength of U.S. dollar would delay necessary increase of U.S. interest rate. And at the same time, I think after June 23rd, clearly UK economy will be in recession at some point. So that would exacerbate this divergence between US interest rate and short-term interest rate of major economies. And that's a problem. I don't think anyone has good answer to that divergence.
Of course, the strengthening of US dollar will also mean some shockwaves throughout the emerging economy. So, Mr. John Ross there, what's your take on this?
Yes, it will. But I mean, the two economies that are doing very well at the present time are China and India, and they're not at all relying on monetary policy. They're relying on a huge increase in state investment. China's state investment up until July was up over 20% year on year, and India's also up 20% year on year. I think the difference is the Western economies have been relying really on monetary policy, and China and India have been also adding to that big stimulatory investment policies. So I don't see any reason why India and China should be deeply shaken by any increase in federal interest rates. It will have a negative effect in those economies which don't really undertake state investment. Places like Brazil, for example, and it may have some negative short-term effect on China's financial markets, but it's not going to fundamentally derail either China or India's economy. It'll have some effect outside of these biggest developing economies, which are really in a class of their own at the present time.
Mr. Ross, our studio guest here would like to weigh in on this. Mr. Xu.
Yeah, I think I'm not too sure whether I share that sentiment towards a stimulus package, because right now we are still paying the price for what was being done in November 2008, the so-called 4 trillion RMB stimulus package. That's been well recognized, has to do with asset quality, has to do with overcapacity. So right now we have a very big battle to fight, I mean, in several sectors. So I think at this point, we should be very, very careful about fiscal stimulus.